Imagine waking up one ordinary Tuesday morning, pouring your coffee, scrolling your phone, and then the notification hits. Every major news outlet, every financial app, every push alert screaming the same headline. The United States national debt has officially crossed $50 trillion. Not 40, not 45, 50 trillion. You feel a cold twist in your stomach because you've heard the warnings for years, but they always felt distant, like something politicians would fix later. Yet here it is, later has arrived, and in that single moment the world you thought you understood begins to crack. Your savings account, your 401k, a house you've been paying off for 15 years, the college fund you've been quietly building for your kids. Everything suddenly feels exposed, fragile, as if the edge of a cliff you never saw coming. This is not science fiction. This is not fear-mongering for clicks. This is the scenario that bond traders whisper about in private, that central bankers lose sleep over, that the Congressional Budget Office has already mapped out in chilling detail. And the most terrifying part, we are not decades away from this day. We are years away, maybe only months, because the debt is already surging past 38 trillion as I speak, adding roughly 2 trillion every single year, sometimes more when Congress passes another emergency spending bill. The countdown is real, the clock is ticking, and when that $50 trillion threshold is finally breached, a chain reaction will begin that touches every dollar you own, every paycheck you earn, every dream you have for retirement. Tonight we are going to walk through exactly what happens on that day and in the weeks and months that follow, step by devastating step, so that when the headlines finally scream the news, you have already seen it coming, and you know precisely how money, power, and your future will change forever. The first thing you will notice is silence. Markets do not open with a bang. They open with an eerie hush because the smartest traders, the ones who move billions before breakfast, have spent the night positioning themselves for what is about to unfold. By the time the New York Stock Exchange rings its opening bell, the US Treasury market, the deepest, most liquid bond market on the planet, is already bleeding. Foreign investors, pension funds, sovereign wealth funds that spent decades treating treasuries as the ultimate safe asset, suddenly see the United States government owing more than double the size of its entire economy, and they begin to sell. Not in a blind panic, not yet, but quietly, methodically, the way you would ease out of a burning building before anyone else notices the smoke. Bond prices fall, which means yields rise, and within hours the benchmark 10-year Treasury yield jumps from 4.5% to 6%, then 7%, then 8% in a single session. A move that has not happened since the dark days of 1981. Mortgage rates, car loans, credit card rates, student loan rates. Every form of borrowing in America is priced off that 10-year yield. So by lunchtime on that first day, the average 30-year mortgage has shot past 10%. And home buyers who were pre-approved last week suddenly cannot afford the same house anymore. Real estate agents stare at empty open houses, construction sites go quiet, and the entire housing market, still the primary source of middle-class wealth in America, begins to freeze solid. But the pain does not stay in the bond market. It spills into your bank account faster than you think possible. Banks themselves hold hundreds of billions in Treasury securities as their safest assets, the collateral that allows them to lend to you and me. When those bonds lose value overnight, bank balance sheets take an immediate hit, and regulators, remembering 2008 all too well, force banks to raise capital quickly. That means lending standards tighten dramatically. The home equity line of credit you were planning to use for renovations vanishes. The small business loan your brother needed to keep his restaurant afloat is pulled. Credit card limits are slashed without warning. At the same time, the Federal Reserve is holding an emergency meeting because the spike in yields threatens to bankrupt the government itself. Interest payments on the national debt, already close to $1 trillion a year, are now on a trajectory to double or triple within months. The Treasury Department has to auction new debt just to pay the old debt. But with yields exploding, every new auction attracts fewer buyers and requires even higher interest rates to clear. A vicious doom loop begins. Higher rates mean higher interest costs. Higher interest costs mean more borrowing. More borrowing means even higher rates. Inside the Fed, the debate rages. Print money to buy the bonds and cap the yields, the way they did during COVID, or let rates rise and risk an instant recession. They choose to print because the alternative is watching the government default in slow motion. And so the digital printing presses fire up again, trillions of new dollars flood the system, and the purchasing power of every existing dollar in your wallet begins to evaporate in real time. By the end of that first week, inflation, which had finally cooled to around 3%, roars back to life with a vengeance. Import prices surge because the dollar is falling on currency. Markets as investors flee to gold, to Swiss francs, to anything that isn't backed by a government $50 trillion in debt. Gasoline tops $6 a gallon nationwide. Groceries jump 15% in a single month. And the wage raise you negotiated last quarter is already worthless. Meanwhile, the stock market, which had been shrugging off debt warnings for years, finally cracks. Retirement accounts lose 20, 30, 40% of their value as companies slash dividends, lay off workers, and cancel expansion plans in the face of crippling borrowing costs. The phrase wealth effect goes into reverse. Americans feel poorer, so they spend less, companies earn less, layoffs accelerate, and the economy tips into recession almost overnight. But this is not a normal recession. This is what economists quietly call a debt deflation spiral on steroids, where falling asset prices and rising interest rates feed on each other in a cascade that becomes almost impossible to stop. And the scariest part is that the government, the one institution everyone expects to ride to the rescue, is the one that is broke. Social Security checks still go out for now, but Medicare payments to hospitals begin to be delayed. Federal employees are furloughed. Military bases overseas are told to ration fuel. The world watches in stunned disbelief as the issuer of the global reserve currency teeters on the edge of a funding crisis. Yet even as America burns through its last remaining credibility, something even darker begins to happen behind the scenes. Creditor nations, Japan, Saudi Arabia, even allies in Europe, start diversifying away from dollar assets at warp speed because no one wants to be the last one holding a $50 trillion IOU. The dollar loses reserve currency status, not with a dramatic announcement, but gradually, then suddenly, the way Hemingway described going bankrupt. Global trade in oil, commodities, microchips begins to be priced in other currencies. Central banks dump treasuries in coordinated waves, and the Federal Reserve is forced to intervene with tens of trillions in emergency purchases just to keep the system from seizing up completely. The word hyperinflation starts appearing in mainstream headlines, something no living American has ever experienced. And grocery store shelves begin to look like scenes from Venezuela or Weimar, Germany, as people rush to spend money before it loses even more value tomorrow. Gold crosses $10,000 an ounce. Bitcoin surges past $500,000, and physical cash, actual paper dollars, become strangely valuable because digital dollars are being created by the trillions every week, and no one trusts them anymore. And then comes the moment that changes everything forever, the political breaking point, with tax revenues collapsing and interest payments consuming more than half the federal budget. Congress has only two choices: savage spending cuts that would throw millions into poverty, or outright money printing on a scale that guarantees the dollar's destruction. They choose a third path, one that has been war-gamed in secret for years but never spoken aloud: financial repression on a massive scale. Interest rates are capped by law, banks are forced to buy treasuries at below-market yields, pension funds and 401k plans are quietly required to hold a minimum percentage of government debt, and a modern version of the 1940s war bonds campaign is launched, except this time it isn't voluntary. Your retirement money, the money you thought was yours, is slowly, legally, conscripted into financing the government's survival. The stock market may recover eventually, but the purchasing power never does. A generation that saved diligently, that played by the rules, that believed in the American dream, wakes up to discover that the dream has been taxed, inflated and regulated into something unrecognizable. The middle class does not disappear in revolution. It evaporates in slow motion through the erosion of the currency itself. But here is the twist nobody saw coming. Out of the ashes of the old dollar order, something new begins to emerge. Blockchain-based stablecoins, digital gold, central bank digital currencies backed by real assets. All the technologies that were mocked as toys during the boom years suddenly become lifelines. Communities that prepared, families that held hard assets, individuals who learned to think in ounces and satoshis rather than dollars, find themselves not just surviving but thriving in the new reality. The United States does not collapse into chaos. It transforms painfully, messily, into a different kind of economy, one where trust in government, money is gone forever, and trust must be earned by mathematics, scarcity, and transparency. The $50 trillion day does not mark the end of America. It marks the end of the 1944 Bretton Woods illusion that a government can borrow infinite amounts without consequence. And when the dust finally settles years from now, historians will look back and realize that the crisis was not caused by foreign enemies or partisan gridlock alone, but by a simple, tragic truth we refuse to face. No nation, no empire, no currency in history has ever survived the kind of debt binge we allowed to happen. The day the debt hit 50 trillion was not the day America fell. It was the day we were finally forced to grow up.